Silver has just printed its 10th consecutive green month. Gold has now closed at a record high for the 7th straight month. Read that again carefully. 10 months for silver, 7 straight records for gold. This is not noise. This is not a one-week short squeeze. This is not a headline-driven spike that fades by Friday. What we are witnessing right now is one of the most persistent and historically rare streaks in modern precious metals history. Markets do not move in straight lines for this long without something structural underneath them. Random speculation does not sustain a 10-month advance. Retail hype does not carry gold to record closes month after month. When you see this kind of consistency, you are not looking at emotion. You are looking at capital rotation. And that distinction matters. For most of the past decade, silver has been the forgotten metal. It lagged, it frustrated, it broke out only to be smashed back down by paper selling. It tested patience repeatedly. Gold, meanwhile, quietly built a base, grinding higher in slow, disciplined steps. Many investors lost focus. Some rotated into high-growth equities. Others chased crypto volatility. Precious metals were dismissed as relics in a world obsessed with AI multiples and tech narratives. But streaks like this do not happen in isolation. They happen when capital begins to reassess risk. 10 green months in silver means that for nearly a full year, every monthly close has been higher than the one before it. That signals something far more powerful than intraday momentum. It signals sustained accumulation. It signals buyers stepping in consistently on weakness. It signals that dips are being absorbed, not panicked. Gold's 7 straight record monthly closes tell a similar story. Records are not broken by accident. They are broken when long-term resistance is cleared and defended. Each new monthly record close becomes the new support layer. That is how structural bull markets form. They do not explode in a single candle, they build a staircase. To understand why this matters, we have to zoom out. The last time silver experienced extended multi-month green streaks of this magnitude, it was during regime shifts. In the 1970s, it coincided with inflation shocks and currency revaluation. In the early 2000s, it aligned with the early stages of the commodity supercycle. In 2010 and 2011, it occurred during aggressive monetary expansion after the financial crisis. Today, we are again in a transition phase. Global debt has reached levels that would have been unimaginable 20 years ago. Sovereign interest payments are no longer theoretical concerns. They are line items swallowing national budgets. Central banks are walking a narrow path between sticky inflation and financial stability. Bond markets have become unstable. Currency volatility is rising quietly beneath the surface. When systems stretch, capital seeks anchors. Gold is the historical anchor. It does not default. It does not depend on counterparty promises. It does not require trust in a third party. That is why central banks have been accumulating it aggressively in recent years. And silver, often dismissed as merely industrial, sits at a fascinating intersection. It is both monetary and industrial. It benefits from safe haven flows and from structural demand in energy, electrification, and advanced technology. 10 consecutive green months suggest that this dual narrative is no longer hypothetical. It is being priced in. Another important point: streaks compress volatility perception. When markets grind higher steadily, complacency can creep in. But long streaks also tighten supply. Every month that closes green removes weak hands from the equation. Short sellers become cautious. Momentum funds increase exposure. Physical holders grow more confident. Supply available at lower price levels gradually disappears. That process does not show up in a single day. It reveals itself in statistics like this. Now, some will argue that streaks eventually end. That is true. Nothing trends forever without correction. But the key question is not whether there will be pullbacks. The key question is what those pullbacks represent. In fragile rallies, pullbacks signal exhaustion. In structural bull markets, pullbacks signal consolidation before continuation. So far, silver and gold have treated corrections as pauses, not reversals. We also have to consider correlation shifts. In previous cycles, metals often rallied alongside aggressive liquidity injections. Today, the environment is more complex. Rates have not returned to zero. Balance sheets are not expanding at crisis-era speed, yet metals continue to climb. That tells us something subtle but important. This rally is not purely liquidity-driven. It is confidence-driven. Confidence, or rather, the erosion of it. When investors begin to question long-term currency purchasing power, they do not necessarily panic in a single week. They rebalance gradually. They reduce exposure to long-duration assets vulnerable to inflation surprises. They increase allocation to hard assets. They diversify away from concentrated tech risk. That reallocation shows up as steady, disciplined buying. 10 green months do not happen because of a viral tweet. They happen because institutions adjust portfolios quarter after quarter. There is also the supply side of the equation. Silver mine production has struggled to grow meaningfully in recent years. Large new discoveries are rare. Development timelines stretch over a decade. Meanwhile, industrial demand linked to electrification and energy infrastructure continues to expand. When steady investment demand meets constrained supply, the path of least resistance tends to be higher. Gold's record streak reinforces the signal. When gold moves to sustained records, it is often telling you something about the macro backdrop before headlines catch up. It is a quiet messenger. It moves when risk models begin to price in tail scenarios. It moves when central banks diversify reserves. It moves when long-term capital quietly hedges. 7 straight record months is not excitement, it is positioning. So where does this leave us? We are at a moment where momentum and macro are aligned. Silver's 10th green month confirms trend persistence. Gold's 7th record confirms structural demand. Together they suggest we are not looking at a temporary spike. We are likely witnessing the early to middle phase of a broader repricing cycle. The real question now is not whether this streak is historic, it clearly is. The real question is what phase of the cycle we are in, and what that means for positioning going forward. If this is early structural repricing, corrections will be opportunities. If this is late cycle euphoria, volatility will expand rapidly. The data so far leans towards structure, not euphoria. But structure does not eliminate risk. It simply changes how risk behaves. Before we move into the historical comparisons and what previous streaks led to, pause and understand the weight of what is happening. 10 green months in silver, 7 record months in gold. Markets whisper before they scream. Right now, they are whispering that something bigger than short-term speculation is unfolding. To understand what may follow a streak like this, we need to study what similar streaks have historically led to. Markets are not identical across decades, but they rhyme. Patterns repeat in structure even when the headlines differ. Let's go back to the 1970s. That era was defined by currency instability, oil shocks, and inflation that policymakers struggled to contain. Precious metals did not move in a straight line. They advanced in waves. What stood out during that period were multi-month stretches of consistent gains that signaled a regime change in how investors viewed money itself. Gold broke prior ceilings and kept building new floors. Silver followed with higher beta, more volatility, but persistent upward pressure. The common denominator wasn't simply inflation, it was distrust in monetary stability. Now fast forward to the early 2000s. After the dot-com collapse, capital rotated away from speculative equities and into tangible assets. Gold began a steady, multi-year climb. Silver lagged initially but eventually accelerated. There were extended green streaks, not explosive daily candles, but disciplined monthly advances. That period marked the beginning of the commodity supercycle that ran through 2011. Again, the core driver was structural repositioning, not short-term speculation. In 2010 and 2011, we saw aggressive monetary expansion following the financial crisis. Liquidity flooded the system. Precious metals responded with powerful moves. But even during that surge, the market's foundation was built on persistent monthly closes that formed a staircase pattern before the parabolic phase. The lesson across these cycles is clear. Sustained streaks are rarely the end of a move. More often, they represent the early to middle phase of broader structural shifts. Today's environment is different in the details but similar in architecture. Instead of oil embargoes or dot-com crashes, we face sovereign debt levels that stretch the limits of fiscal sustainability. Instead of a single banking crisis, we have a web of interconnected leverage across real estate, derivatives, and government balance sheets. Instead of one region struggling with inflation, we have synchronized pressure across multiple major economies. The global system is more complex than ever, and that complexity breeds fragility. When fragility rises, capital seeks assets that do not rely on layered promises. Gold benefits from that instinct. Silver benefits both from that instinct and from industrial necessity. Another important historical parallel involves currency cycles. Precious metals often outperform during periods when the dominant reserve currency experiences structural stress. That stress does not need to manifest as immediate collapse. It can show up as gradual devaluation, rising volatility, or widening deficits. The market begins to anticipate long-term purchasing power erosion before it becomes visible in everyday prices. 7 consecutive record months in gold suggest that currency risk is being repriced quietly. Now consider investor psychology. In fragile markets, rallies tend to be short-lived. Participants sell strength quickly, unwilling to commit. In structural bull phases, pullbacks are bought methodically. The defining characteristic becomes higher lows, not explosive highs. Silver's 10 green months imply that higher lows are being defended consistently. That is a sign of conviction. Conviction does not appear out of thin air. It develops when capital believes the macro backdrop justifies allocation. Central bank buying of gold in recent years has been well documented. What is less visible is the slow expansion of institutional mandates that include hard assets as strategic hedges. Pension funds, sovereign funds, and family offices do not pivot overnight. They adjust allocations gradually, quarter by quarter. When that kind of capital moves, streaks form. Another factor worth examining is volatility compression. Extended green streaks often coincide with reduced perceived risk in the asset itself. As metals climb steadily, the narrative shifts from volatile trade to strategic allocation. That shift attracts a different class of investor. Instead of traders looking for quick moves, longer-term holders step in, their holding periods extend, liquidity tightens, volatility may actually decrease temporarily, even as prices rise. Eventually, that compression can lead to expansion, but expansion typically comes after the structural base is built. Let's also examine positioning data. In prior cycles, sustained advances often coincided with short interest gradually unwinding. As streaks continue, short sellers become less aggressive. The cost of fighting the trend increases. When shorts reduce exposure, downward pressure decreases, allowing underlying demand to express itself more clearly. If the current streak persists, it could signal that the long-standing paper headwinds in the silver market are weakening. However, history also warns us about complacency. In 2011, silver experienced a powerful rally that eventually overshot into euphoria. The parabolic phase drew in late entrants at extreme levels. When corrections came, they were sharp. The difference between structural advance and speculative mania often lies in pace and narrative tone. Right now, the pace appears disciplined. The narrative is still skeptical in many corners. Mainstream headlines are not yet celebrating silver as the trade of the decade. Gold records are mentioned, but they are not dominating front pages. That subdued sentiment suggests we may not be at a euphoric peak. Another comparison worth noting is the early stages of commodity cycles. Commodities often move together when supply constraints and capital underinvestment collide with rising demand. Silver's industrial applications tie it to broader energy and electrification themes. If those structural demand drivers remain intact, silver could benefit from a multi-year tailwind independent of short-term macro noise. 10 green months may therefore represent more than momentum. They may represent the market's acknowledgement that supply growth cannot easily match demand growth. We should also consider cross-asset behavior. During previous regime shifts, metals often moved before broader market stress became visible. They acted as early indicators. If gold continues setting records while equities face volatility, that divergence could widen. If bond yields remain unstable, metals may attract additional defensive capital. The key takeaway from historical parallels is this: sustained streaks are signals, not guarantees. They signal that the underlying forces driving the asset are persistent. They do not guarantee a straight path upward. Corrections are part of every cycle. But history suggests that when streaks align with structural macro stress, they tend to precede larger moves rather than conclude them. We now stand at a crossroads. The market has delivered the data: 10 green months in silver, 7 straight records in gold. History tells us that such persistence often emerges during transitional monetary phases. The question becomes whether the current environment qualifies as one. To determine whether this streak is rooted in temporary momentum or systemic repricing, we have to examine the present macro landscape with discipline, not emotion, not ideology, just structure. Start with debt. Global sovereign debt has expanded to levels that would have once been considered emergency conditions. Today, those levels are normalized. Governments are rolling over trillions in obligations at higher interest rates than they carried just a few years ago. The cost of servicing that debt is rising steadily, and unlike discretionary spending, interest expense cannot be deferred. It compounds. When debt servicing grows faster than revenue, policymakers face limited choices: raise taxes, cut spending, inflate away liabilities, or rely on financial repression. Historically, inflation has often been the quiet solution. Inflation does not need to be explosive to matter. Even moderate, persistent inflation erodes purchasing power over time. Investors understand this. When long-term purchasing power becomes uncertain, strategic allocation shifts toward assets that historically preserve value across monetary cycles. Gold thrives in that environment. Now consider monetary policy. Central banks are navigating a narrow corridor. raise rates too aggressively and you strain credit markets, commercial real estate, and leveraged sectors. Ease too quickly and inflation expectations can reaccelerate. The margin for error is thin. Even when policy remains steady, forward guidance becomes a variable that markets must interpret. That uncertainty creates volatility in bonds and currencies. Currency volatility is often the silent catalyst behind precious metals moves. When investors sense that the dominant reserve currency may face structural headwinds, whether through deficits, trade imbalances, or geopolitical fragmentation, they diversify, not necessarily out of panic, but out of prudence. Gold's 7 record months suggest that diversification is occurring. Then there is geopolitics. The global trading system is less cohesive than it was a decade ago. Sanctions, trade barriers, and strategic resource policies are increasingly common. Nations are reevaluating supply chain dependencies. In that environment, commodities become strategic assets rather than mere inputs. Silver occupies a unique position in this context. It is essential to modern industry. Solar infrastructure, electronics, electrification, and defense technologies all depend on it. Industrial demand is not optional. It is embedded in long-term capital expenditure cycles. At the same time, silver maintains monetary characteristics. It has a history as money. It remains a store of value in many cultures. When macro uncertainty rises, silver can experience dual demand pressure from industry and from investment. That combination tightens markets. Another factor is capital rotation. For years, equity markets, particularly large technology names, captured disproportionate flows. Valuations expanded, multiples rose, capital concentrated. When concentration reaches extremes, even subtle shifts in sentiment can trigger rebalancing. If institutions begin trimming overextended exposures and allocating incrementally to hard assets, that shift does not show up in a single week. It shows up in streaks. 10 green months imply that allocation is happening gradually. We should also examine the bond market. Government bonds have historically been the defensive anchor in portfolios, but when yields rise rapidly or price volatility increases, bonds lose some of that stabilizing function. If bonds and equities both exhibit volatility, portfolio managers seek alternative hedges. Gold often fills that role. Silver can follow, especially if the macro narrative broadens to include supply constraints and industrial momentum. Another element worth noting is real interest rates. Precious metals tend to perform well when real rates, nominal rates minus inflation, are low or declining. Even if nominal rates appear elevated, if inflation remains persistent, real returns on cash and bonds can be modest. Investors watching real returns adjust allocations accordingly. The current environment reflects that tension. Let's not ignore sentiment. Despite the streak, broad retail enthusiasm for precious metals remains relatively muted compared to prior euphoric phases. There are pockets of enthusiasm, but we are not witnessing widespread mania. Mainstream narratives still prioritize growth stocks, artificial intelligence breakthroughs, and macro speculation over metals. That subdued sentiment is important. It suggests that the rally has not yet entered its speculative climax phase. We must also acknowledge potential counterarguments. Some will say this streak is simply a lagged reaction to earlier liquidity expansion. Others will argue that metals are overextended and due for correction. Both perspectives deserve consideration. Corrections are inevitable in any sustained move. No market advances without retracement. But corrections within structural bull markets often reset positioning rather than terminate trends. The key distinction is whether corrections break long-term support or merely consolidate gains. So far, silver and gold have shown resilience during pullbacks. Dips have been met with buying interest rather than cascading liquidation. That behavior reinforces the structural thesis. Now consider supply dynamics. Silver production growth has not accelerated meaningfully. Bringing new mining projects online requires time, capital, and regulatory navigation. Meanwhile, industrial consumption linked to electrification and advanced manufacturing continues expanding. If demand growth outpaces supply growth even modestly, the imbalance compounds over years. That is how commodity cycles build quietly before accelerating. Gold supply is also relatively inelastic. Annual mine production grows slowly. Above-ground stock exists, but central bank accumulation can remove available liquidity from the market. When official sector buying persists, it signals long-term strategic positioning. 7 record months imply sustained demand at scale. Taken together, debt expansion, monetary uncertainty, currency volatility, geopolitical fragmentation, capital rotation, real rate tension, supply constraints, The macro environment aligns with conditions that have historically supported precious metals. This does not guarantee a straight line ascent. It does suggest that the current streak may be rooted in structural forces rather than transient speculation. The remaining question is timing and phase. Are we in early accumulation, mid-cycle expansion, or late-stage acceleration? The measured pace of advance and subdued sentiment suggest we may be closer to early to mid-cycle than late-stage euphoria. But markets can evolve quickly. If gold is the anchor, silver is the amplifier. That relationship has defined every major precious metals cycle for decades. Gold typically moves first. It attracts institutional capital seeking stability. It responds to currency shifts and central bank flows. Silver follows with greater volatility, greater percentage swings, and often greater upside once momentum builds. When silver prints 10 consecutive green months while gold sets 7 straight records, the message is not subtle. It suggests that silver is no longer lagging quietly in gold's shadow. It is beginning to assert its historical role as the leveraged expression of the broader metals cycle. To understand what this could mean, we have to examine the gold to silver ratio. Historically, the ratio expands during periods of stress and contracts during sustained bull phases. When fear dominates, gold outperforms silver because it is perceived as the purer monetary hedge. When confidence in the bull trend strengthens, silver accelerates and the ratio compresses. Extended green streaks in silver often coincide with the early stages of ratio compression. If gold continues to set records while silver maintains monthly gains, it signals a synchronized advance. But if silver begins outperforming gold decisively, that is when the cycle typically transitions into its more explosive phase. During the early 2000s, gold climbed steadily before silver dramatically outpaced it in the later years of the cycle. In 2010-2011, silver's acceleration shocked many investors who had viewed it as perpetually constrained. The move was not random, it was the natural release of compressed momentum. Today's streak suggests compression may be building again. Another critical factor is market size. The silver market is significantly smaller than gold's. It takes less capital to move it. When incremental institutional flows begin targeting silver, even modestly relative to global capital pools, price sensitivity increases. 10 consecutive green months imply that incremental capital is arriving consistently. Silver's industrial component adds another dimension. If gold's rally is rooted primarily in monetary hedging, silver benefits from both monetary hedging and industrial expansion. That dual demand can amplify price reactions when supply is tight. Consider electrification. Renewable energy installations require significant silver input. Advanced electronics rely on its conductivity. Defense systems and emerging technologies depend on it. Industrial demand does not evaporate easily during moderate economic fluctuations. If industrial consumption remains steady while investment demand grows, the market tightens structurally. There is also the issue of above-ground supply. While silver has historically been considered abundant, much of it has been consumed in industrial applications and is not economically recoverable. Unlike gold, which is largely held and recycled, silver is dispersed across products. That means incremental investment demand can have disproportionate effects. Another piece of the puzzle is derivatives positioning. Silver's paper market has long been a subject of debate, with large short positions historically exerting pressure. Sustained green streaks suggest that short sellers are either reducing exposure or struggling to cap advances. When paper resistance weakens, price discovery can accelerate, but caution is necessary. Silver's volatility cuts both ways. In previous cycles, once acceleration begins, it can overshoot dramatically. The same leverage that drives rapid gains can produce sharp corrections. Long-term investors must differentiate between structural opportunity and speculative frenzy. Right now, sentiment remains relatively measured. We are not seeing widespread retail mania. We are not witnessing mainstream headlines proclaiming silver as the asset of the decade. Instead, the rally appears steady, almost understated. That is often how structural moves begin. Let's also consider capital psychology. Many investors who missed early gains in gold may look to silver as a perceived catch-up trade. That dynamic has repeated historically. When gold sets records, silver often becomes the narrative of opportunity. If this shift accelerates, the 10th green month could become a reference point, the moment when silver transitioned from recovery to expansion. There is also portfolio construction logic. For institutions seeking exposure to precious metals, silver provides diversification within the metals allocation. If gold becomes fully allocated or perceived as extended, incremental capital may target silver for relative value. Relative value analysis often fuels momentum in later stages of cycles. Now examine volatility patterns. During early structural phases, volatility often declines slightly as trends stabilize. Once the broader market recognizes the shift, volatility expands. That expansion can produce large monthly candles, both positive and negative. Silver's 10-month streak has not yet shown signs of parabolic blow-off behavior. That suggests we are not in late-stage euphoria. Another metric to watch is physical market tightness. When premiums expand and delivery timelines stretch, it signals stress in supply chains. While physical markets are not the sole determinant of price, they provide insight into demand pressure. If sustained green streaks coincide with tightening physical conditions, the structural case strengthens. It is also important to consider macro correlations. If equity markets remain volatile and bond markets unstable, metals can attract incremental hedging flows. If economic growth slows, while inflation remains elevated, stagflationary conditions historically support silver's dual role. But if global growth contracts sharply, industrial demand could moderate temporarily, affecting silver differently than gold. That scenario would test the resilience of the streak. Therefore, positioning requires balance. Structural conviction must coexist with risk management. 10 green months signal persistence, not invincibility. Gold's 7 record closes reinforce the macro backdrop. Silver's streak suggests leverage within that backdrop. Together, they point toward a metal cycle that may still be unfolding rather than concluding. The critical takeaway is this: silver's behavior relative to gold in the coming months will reveal the cycle's phase. If silver begins outperforming decisively while gold consolidates at record levels, acceleration may be underway. If both continue steady advances with measured volatility, the structural phase likely remains intact. In the final part, we will bring everything together: streak analysis, historical parallels, macro forces, and positioning logic, and outline what disciplined investors should monitor as this historic phase develops. Now we bring it together: 10 consecutive green months in silver, 7 straight record monthly closes in gold. Historical parallels suggest that streaks of this persistence rarely mark endings. They more often signal transitions, from skepticism to acceptance, from underallocation to strategic positioning. The macro backdrop supports the move. Sovereign debt burdens are heavy. Currency volatility is rising beneath the surface. Real rates remain uncertain. Central banks are diversifying. Industrial demand for silver continues to expand, while mine supply struggles to grow meaningfully. Capital rotation is subtle but visible. At the same time, sentiment is not euphoric. Mainstream narratives are not dominated by silver mania. Volatility remains contained relative to previous blow-off phases. Those characteristics lean toward early to mid-cycle structure rather than late-stage exhaustion. But discipline matters. Structural bull markets still correct. Pullbacks will come. Headlines will oscillate. Volatility will test conviction. The key difference in this phase is how markets respond to weakness. If dips continue to be absorbed and higher lows remain intact, the streak becomes foundation rather than anomaly. Watch the gold-to-silver ratio. Watch real rates. Watch currency stability. Watch physical demand indicators. Watch whether gold can hold record levels during macro turbulence. Those signals will reveal whether this is a sustained repricing cycle or a temporary surge. Markets whisper before they scream. Right now, silver's 10th green month and gold's 7th straight record are whispers of structural change. Whether those whispers evolve into the kind of acceleration history has shown before depends on how capital behaves in the months ahead. But one thing is undeniable: streaks of this magnitude do not occur in stable monetary eras. They occur when the system is adjusting, and adjustment phases are where long-term wealth cycles begin.